For the first time in over 20 years, the average rate on a 30-year fixed interest rate mortgage across the United States has hit 8%. Compare this to the average in 2021 of 2.96%, and it's easy to quickly see that people today are paying substantially more for their mortgages, leading to the question of what can I do to pay my mortgage faster and reduce the amount of interest I need to pay. Well, in today's video, we're going to take a closer look at how someone could potentially leverage velocity banking to pay off their mortgage faster and reduce the amount of interest. We'll cover off how the strategy works, go over an example using current interest rate averages, and lastly, determine whether or not velocity banking is a feasible strategy in today's economic and financial climate. For those new to the channel, welcome to Concepts Made Simple. On the channel, we aim to cover unique financial topics that you may not hear about every day in a clear and concise way. If you're looking for more content related to velocity banking and other unique financial topics, please consider subscribing to the channel down below and liking the video if the content is helpful to you. So how does velocity banking work to help pay down your mortgage? Well, it involves leveraging a line of credit, typically a home equity line of credit, also commonly known as a HELOC, to reduce the balance on my mortgage. In simple terms, I'm leveraging the funds from my HELOC to then make extra payments onto my mortgage, which can then result in paying my mortgage faster and saving on interest. But you're probably wondering, what is the point of taking on more debt to pay off my existing debt on my mortgage? Wouldn't that just leave me in the same place that I started? Well, part of this is true, and that is that you are essentially transferring a portion of your mortgage onto your line of credit. However, the key difference lies in the fact that the interest is calculated differently on a mortgage versus a HELOC or other lines of credit, and that is the difference between compound and simple interest. You've probably heard many times people talk about how if we give our investments time to grow and compound over time, this can lead to exponential growth. But the same is true for when we let our debt compound over time. Compound interest takes into account both the principal amount and the accumulated interest from previous periods. As time progresses, the interest is added to the principal, and subsequent interest calculations are based on this new, higher amount. On the other hand, simple interest is calculated on the initial principal only, and it remains constant over the entire period. And this is the interest that is typically used on lines of credit, like a HELOC. But now you're probably wondering, wouldn't a line of credit typically come with a higher interest rate than a mortgage? And that would be a correct assumption, as according to the most recent Fed data from the United States, the average interest rate on a personal line of credit, like a HELOC, is currently sitting around 11.48%. And although in the majority of cases a person's line of credit will carry a much higher interest rate than their mortgage, velocity banking can still be successfully implemented. Let's take a look at an example to see why this is the case. Robert recently took out a $500,000 30-year fixed-rate mortgage on his new home at 8%. Robert would like to implement velocity banking, but he first needs to get access to a line of credit. After applying, Robert is given a HELOC of $20,000 at an interest rate of 15%. However, it is important to note that the rate an individual receives on a HELOC is determined by many different factors, such as the current prime rate, their credit score, and their loan-to-value ratio. The loan-to-value ratio is the ratio of your outstanding mortgage balance and the appraised value of your home. The lower the loan-to-value ratio that you have, the better interest rate that you may receive. Now, let's imagine a scenario where Robert does not use velocity banking and instead just makes his monthly payment of around $3,668 over the 30-year period. And in total, over this 30-year period, Robert will pay over $1.3 million in both principal and interest. From this amount, over $820,000 is in interest, and that will go directly into the bank's pocket. And at what point in the mortgage will Robert be paying the highest amount in interest? Well, that would be at the start of the mortgage, where the majority of his monthly payment of $3,668 goes towards interest and not equity in his home. So how can Robert put velocity banking into action to lower the balance on his mortgage so that he's paying less interest? This is where Robert can leverage his HELOC to make a large lump sum payment onto his mortgage. Robert will take the $20,000 from his HELOC and put the entire thing onto his mortgage, bringing his mortgage balance down to $480,000. On the other hand, if Robert didn't make this lump sum payment and just made his monthly payment, it would take him nearly 4 years to get the balance down to $480,000, meaning it would take Robert 4 years to just have his equity in his home go up by 4%. But of course, Robert will still need to pay his 15% interest on his HELOC. But it is critical to keep in mind that the interest on this HELOC is simple interest, meaning that it is calculated using the average daily balance. So what Robert can then do is pay all of his expenses through his HELOC to help lower his average daily balance. Robert currently has a monthly income of $6,500 and $5,000 in monthly expenses. His mortgage payment of $3,654 is included in this $5,000 of expenses. So Robert can then take his monthly income of $6,500 and put it all onto his HELOC, which will then reduce his balance from $20,000 to $13,500. Now, throughout the month, Robert will then pay his $5,000 in expenses from his HELOC. Since all of Robert's expenses won't be coming out all at once, this will in turn help him to lower his average daily balance. After around 14 months, Robert will have paid the line of credit in full and can now repeat the process of making a $20,000 lump sum payment onto his mortgage. During this period, Robert will still be paying his 15% rate on his HELOC. 15% on his $20,000 balance is equal to $3,000 a year. But in Robert's case, this interest will be much lower because his balance will never be above $20,000 as he is paying all of his income onto his line of credit, resulting in a lower average daily balance. Now, compare this to our other scenario, which is if Robert just made his monthly mortgage payment and nothing extra. As previously mentioned, it would take him 4 years to get his balance down to $480,000, which Robert did immediately by using his HELOC. And over this 4-year period, Robert would pay a total of approximately $160,000 in interest. As we can see in this example, the advantage of using velocity banking lies in the fact that we're able to pay down our amortized mortgage in a lump sum payment and then pay back our HELOC, which is based around simple interest. However, it's important to note that Robert needed additional monthly cash flow to make this work. Robert had a monthly income of $6,500 and $5,000 in expenses, leaving him with a monthly cash flow of $1,500, which he can then use as a payment towards his HELOC. Without the additional cash flow, this example would not be possible, as Robert would not be able to satisfy his payment on his HELOC. If Robert is unable to pay back his HELOC, he's at risk of losing his home, as a HELOC is a secured loan, meaning that the loan is backed by his home. That's why, although examples like this can be very eye-opening, it's important to keep in mind that everyone's situation and financial behavior is different, meaning just because something works for someone else doesn't mean it'll work for you. However, given today's high interest climate, it is important as ever to look for strategies that will help pay off your debts faster and save on interest. But what is just as important is to do your proper research and speak with the right people to ensure a strategy like velocity banking will work with your unique situation. If you found this content to be helpful, it would be greatly appreciated if you could consider subscribing to the channel for more content related to velocity banking and everyday finance. This will help the channel grow and ensure we can keep making content like this. Thank you for watching, and we'll see you next time.